America is watching its retail heart ripped out in real time. Once mighty giants that fueled suburban dreams are now gasping for survival. Over 3,000 store closures in a single year have turned bustling shopping centers into graveyards. Tens of thousands of jobs are being erased, and billions in crushing debt are pulling household names into the abyss. Walmart, Macy's, CVS, Walgreens, icons of American commerce, are bleeding cash, slashing payrolls, and abandoning communities. This isn't a gentle decline. This is a full-blown retail apocalypse, a brutal unraveling of the storefronts that once defined everyday life across the nation. Number 10. J.C. Penney. J.C. Penney is the ghost of American retail that refuses to die, but its body is falling apart piece by piece. Once a titan with over 1,100 stores at its peak, today, J.C. Penney is limping along with fewer than 650 stores nationwide, and even that number is shrinking. In 2025 alone, the company confirmed at least 8 permanent closures, which may not sound catastrophic until you realize this is just the tail end of a collapse that saw nearly 200 locations shut down since its 2020 bankruptcy. The chain carries more than $3.8 billion in long-term debt, and sales have cratered from $20 billion in 2006 to barely $7 billion today. That's a 65% implosion in less than 2 decades. Customers aren't coming back. Average foot traffic per store has dropped 40% since 2019, while digital sales are anemic compared to rivals like Target or Walmart. JCPenney's online revenue barely cracks 15% of total sales, a dinosaur in an era where Amazon alone dominates with over $574 billion in annual revenue. Every JCPenney store that closes becomes a retail graveyard, leaving behind empty anchors in malls already plagued by vacancy rates north of 20%. The financial hemorrhage is staggering. Analysts estimate that JCPenney spends $1.2 million annually just to operate each store, but many locations barely generate enough revenue to cover payroll and rent. When you multiply that by hundreds of stores, you're looking at hundreds of millions in losses every year. Worse, its aging customer base is disappearing. The average JCPenney shopper is over 50 years old, while younger demographics consider the brand irrelevant, choosing fast fashion chains like Zara or Shein, which pump out trends at breakneck speed. The truth is brutal. JCPenney is no longer a national brand. It's a slow-motion train wreck bleeding out in front of America's eyes. Each new closure isn't just another struggling store. It's the nail in the coffin of a century-old empire that once defined middle-class shopping. What Sears was 5 years ago, JCPenney is becoming right now. Its fall isn't just business, it's the collapse of an American cultural institution. Number 9. Advance Auto Parts. Advance Auto Parts was supposed to be the reliable pit stop for America's car owners, but today, it looks more like a wreck on the side of the highway. With over 4,700 stores at its peak, the company has announced plans to shut down 700-plus locations by mid-2025, a staggering retreat that screams desperation. Why? Because the balance sheet is bleeding red ink. The company is saddled with over $1.1 billion in long-term debt, while quarterly sales keep missing expectations. Comparable store sales have declined by nearly 3% year-over-year, even as rival AutoZone rakes in billions. The closures come with brutal human costs. Each store employs roughly 10 to 15 workers, which means over 7,000 jobs could vanish in the coming months. Add that to the 1,000 corporate layoffs already executed in cost-cutting programs, and you have a company dismantling itself piece by piece. The pressure is so severe that Advance Auto was forced to slash its dividend by 83% in 2023, a signal flare that spooked investors. Its stock, once trading above $200 a share, now sits in the bargain basement, down nearly 70% in just 3 years. Margins are evaporating. Rising costs of car parts, tariffs on imports, and supply chain delays have crushed profits. The company's net income plunged by 50% last year, barely scraping $200 million on revenues north of $11 billion. That's like running a marathon only to collapse before crossing the finish line. Worse, Amazon and Walmart are eating their lunch in the auto parts e-commerce market. Every percentage of market share lost is tens of millions of dollars gone forever. Advance Auto Parts is not just closing stores, it's amputating limbs to stay alive. But with debt payments looming, shrinking sales, and mass layoffs hollowing out its workforce, the company looks less like a survivor and more like a brand circling the drain. Number 8. Kohl's. Kohl's was once hailed as the suburban department store that could survive the retail apocalypse. But beneath the glossy ads and endless doorbuster sales lies a company sinking under its own weight. With over 1,100 stores nationwide, Kohl's has confirmed it will close 27 underperforming locations in 2025. While that sounds small, it's only the beginning of a slow contraction. Sales have flatlined at around $17 billion annually, a sharp drop from its $20 billion peak in 2019, while operating income has been sliced in half. Debt is the anchor dragging Kohl's into the abyss. The company carries over $6.5 billion in liabilities, and interest payments alone chew through hundreds of millions in cash each year. In 2022, Kohl's dodged a hostile takeover by hedge funds, but the pressure hasn't gone away. Wall Street now openly questions whether the chain can stay relevant. Foot traffic is down nearly 30% since 2019, while e-commerce still lags at only 20% of sales, leaving Kohl's dangerously exposed to online competitors. Layoffs are already hitting the workforce. After a series of efficiency initiatives, thousands of employees, both in corporate offices and in stores, have been let go. Analysts estimate Kohl's has cut over 3,000 jobs since 2020, and the pain keeps spreading. Many malls where Kohl's is an anchor are already hollow shells, with vacancy rates above 25%, meaning each closure accelerates the death spiral of surrounding businesses. The numbers don't lie. Kohl's stock has collapsed from highs near $80 a share in 2021 to barely $20 today, wiping out billions in shareholder value. Each year of declining revenue adds more doubt to the chain's survival. Kohl's isn't just downsizing, it's slowly being suffocated by debt, layoffs, and irrelevance. Number 7. Macy's. Macy's, the so-called Great American Department Store, is unraveling faster than its faded parade balloons. In 2005, it boasted over 800 stores. Today, barely 500 and shrinking. The company has already announced plans to close 66 more stores in 2025, part of a brutal strategy to shutter 150 underperforming locations by 2026. The financial picture is dire. Macy's sits on nearly $7 billion in long-term debt, with annual interest payments draining over $500 million. Revenues have collapsed from $27 billion in 2019 to around $23 billion today, and net income has plunged by more than 40% in just 2 years. Digital sales, while growing, still can't offset the 35% decline in foot traffic since 2019. The layoffs are staggering. Macy's has cut more than 13,000 jobs since 2020, with another 2,300 layoffs announced in early 2025 as the company scrambles to slash costs. Entire corporate offices have been downsized or shut down, while thousands of retail workers find themselves suddenly unemployed. These aren't temporary furloughs. These are permanent cuts signaling Macy's knows the future looks darker by the day. Even its flagship stores are bleeding. The Herald Square. Macy's in New York, once a symbol of unstoppable retail dominance, now posts year-over-year sales declines, and operating costs exceed $200 million annually just to keep the lights on. Meanwhile, Amazon has surged past $574 billion in revenue, making Macy's single-digit billions look microscopic. The truth? Macy's is collapsing under a mountain of debt, falling sales, and wave after wave of layoffs. It isn't just losing stores, it's losing its place in American culture. Each closure is more than a business decision. It's another tombstone in the graveyard of once iconic retailers. Number 6. CVS. CVS isn't just trimming fat. It's cutting into the bone of its empire. With over 9,000 locations nationwide, the chain announced plans to shut down nearly 300 stores in 2025, adding to the 900 closures already executed between 2022 and 2024. Each shutdown rips through communities, leaving behind boarded-up shells where pharmacies once stood. Behind the glossy healthcare rebrand lies a company drowning in numbers that scream crisis. CVS shoulders $58 billion in long-term debt, a figure so massive it devours over $2.5 billion annually in interest payments. Revenue still hovers around $350 billion to its insurance arm, Aetna, but profits are crumbling. Net income fell more than 35% in 2024, collapsing to barely $5 billion, a drop that rattled Wall Street. The company has announced thousands of layoffs, with at least 5,000 corporate jobs slashed since last year, and more cuts are rumored as store closures accelerate. Each employee costs about $50,000 annually in wages and benefits, so cutting thousands saves hundreds of millions, but it also decimates morale. Even worse, foot traffic in CVS pharmacies has plunged. Prescription sales are shifting online, while competitors like Amazon Pharmacy are siphoning away billions. Analysts warn that 1 in every 4 CVS stores is unprofitable, a terrifying statistic for a chain that once dominated Main Street. Shareholders are already paying the price. CVS stock has crashed nearly 50% from its peak, wiping out tens of billions in value. The message is brutal. CVS isn't closing stores to optimize, it's retreating in panic. The layoffs, the mounting debt, the shrinking profit margins, they all paint the same picture. The corner drugstore of America is being dismantled before our eyes. Number 5. Walgreens. Walgreens, the pharmacy giant with 8,700 stores, is gutting itself with a chainsaw. The company admitted that 25% of its stores are unprofitable, and it's preparing to shut down over 1,200 locations, with nearly 500 closures scheduled in 2025 alone. That's not a correction, that's a massacre. Debt is suffocating Walgreens. With $36 billion in total liabilities, the chain spends nearly $1.8 billion annually just to service interest. Annual revenue has stalled around $140 billion, but net income plunged below $1 billion in 2024, a collapse of more than 70% in just 3 years. Meanwhile, cash flow is evaporating, leaving the company scrambling to sell off real estate and slash costs. Layoffs are accelerating. In mid-2024, Walgreens cut 10% of its corporate staff, translating to more than 1,600 jobs gone overnight. Add in the store closures, which eliminate another 15,000 retail jobs, and you've got a workforce being gutted on a historic scale. Each closure leaves behind communities without pharmacies, turning medical deserts into reality. The pressure isn't just financial, it's operational chaos. Organized theft is bleeding millions. Foot traffic is down 30% since 2019, and Amazon's pharmacy business is stealing billions in market share. Walgreens stock has cratered from highs near $90 to barely $15, erasing over $30 billion in shareholder value. The truth? Walgreens is collapsing under the weight of bad management, brutal debt, and a retail model that no longer works. This isn't downsizing, it's a chain dismembering itself in broad daylight. Number 4. Big Lots. Big Lots was once marketed as the bargain hunter's paradise, but today, it looks more like a clearance sale for its own survival. With over 1,300 stores nationwide, the company admitted it will close at least 360 locations by the end of 2025, a staggering 27% of its footprint. For a discount retailer, that's equivalent to slashing an artery. The financials are catastrophic. Big Lots carries more than $1.4 billion in debt, while quarterly revenue has fallen by 10% year over year to under $1.2 billion. Worse, the company posted a net loss of $435 million in 2024, wiping out nearly all of its cash reserves. Operating margins are now negative, meaning every store open is literally burning money. Layoffs are spreading like wildfire. Each Big Lots employs 15 to 20 workers, so closing 360 stores means as many as 7,000 jobs gone. The corporate office has already trimmed hundreds of positions, and executives have admitted more layoffs are inevitable. The bargain bin business model has collapsed under inflation. Rent is higher, wages are higher, and freight costs have doubled since 2019. Selling $5 chairs and $10 coffee tables doesn't pay the bills when the supply chain alone eats millions. Meanwhile, rivals like Dollar General and Walmart have devoured Big Lots' customer base. Its stock? A horror story. Shares once traded above $70, but now hover under $5, a 90% collapse that screams bankruptcy risk. Analysts openly warn that without radical restructuring, Big Lots could be the next retail casualty. The bottom line, Big Lots isn't just closing stores, it's fighting for its life. Every new closure is another sign that America's discount paradise is collapsing into bankruptcy court. Number 3. Forever 21. Forever 21 was once the crown jewel of fast fashion, pumping out trendy clothes so cheap that millions of teens filled malls every weekend just to buy them by the bagful. But today, the brand is unraveling like one of its $5 tank tops. At its peak, Forever 21 operated over 800 stores in more than 50 countries, but after its 2019 bankruptcy, the empire shrank to fewer than 550 locations worldwide. In 2025, the company announced another wave of closures across U.S. malls, including multiple flagship stores that once anchored billion-dollar shopping centers. The financial wreckage is staggering. Revenues that once topped $4.4 billion annually have plummeted by more than 50%, hovering closer to $2 billion today. The company's mountain of liabilities has ballooned, with debt estimated above $1.2 billion, forcing management into desperate cost-cutting measures. Rent alone devours tens of millions each month, and with mall traffic down 40% since 2015, many locations can't even cover basic operating costs. The layoffs have been relentless. Since 2019, Forever 21 has axed more than 10,000 employees, with another 3,000 jobs at risk in 2025 as store closures mount. Each store employs 30 to 50 workers, and with dozens of closures expected this year, the bloodletting is accelerating. Meanwhile, online competitors like Shein have swallowed Forever 21's customer base whole. Shein now boasts over $40 billion in annual sales, nearly 20 times Forever 21's dwindling revenue. Even efforts to pivot online have flopped. Forever 21's e-commerce share lags at under 25% of revenue, a pitiful number when Zara and H&M generate more than 40% online. Its attempts to partner with mall brands and relaunch through digital platforms have failed to capture Gen Z, who now view the brand as outdated and uncool. The reality is brutal. Forever 21 is no longer forever. It's a relic gasping for relevance, buried under debt, hemorrhaging stores, and abandoned by the very generation that once made it iconic. Every closure isn't just another failed store. It's the death rattle of an empire that thought fast fashion could last forever. Number 2. Joann. Joann, the fabric and crafts giant once known as Joann Fabrics, is unraveling at the seams. With over 800 stores nationwide, Joann announced in 2025 that dozens of underperforming locations will be shuttered. The move is part of a desperate survival plan after years of mounting debt and declining sales. The financial picture is brutal. Joann holds more than $1 billion in debt, with annual interest costs exceeding $90 million. Revenue, once topping $2.6 billion, has dropped by nearly 20% in just 3 years, slipping under $2.1 billion in 2024. The company's stock, which debuted at $12 a share in 2021, has collapsed to under $1, effectively wiping out billions in shareholder value and flashing bankruptcy warnings in neon lights. The closures carry human costs. Each Joann store employs roughly 25 to 30 workers, and with dozens of closures planned, thousands of jobs are on the chopping block. The company has already cut hundreds of positions at the corporate level, including a round of layoffs in 2023 that eliminated nearly 10% of its headquarters staff. Analysts warn that if sales keep sliding, Joann may be forced to cut deeper, eliminating thousands more jobs across retail locations. The root of the collapse? Declining demand. During the pandemic craft boom, sales skyrocketed, but as lockdowns ended, Joann was left with bloated inventories and plunging foot traffic. Today, mall-based Joann stores see traffic down nearly 35% since 2019, while online craft competitors like Michaels and Amazon dominate digital sales. Joann's e-commerce division generates less than 20% of total revenue, leaving the chain far behind in the digital age. What was once America's crafting paradise has turned into a financial nightmare. With debt mounting, revenue collapsing, and store closures spreading, Joann's unraveling is not just about fabric. It's about the very fabric of a company that may not survive another economic storm. Number 1. Walmart. When even Walmart, the most powerful retailer in the world, starts closing stores, you know America's retail system is in crisis. Walmart operates more than 4,600 U.S. stores, generating over $648 billion in global revenue in 2024. Yet in 2025, the giant announced targeted closures in 6 states, including 6 in California alone, sending shockwaves through the industry. The financial numbers tell a chilling story. Walmart carries a staggering $59 billion in total debt, with annual interest payments exceeding $2 billion. While revenue continues to climb, profit margins are shrinking. Net income, which once comfortably sat above $15 billion annually, dropped by more than 20% in the past 2 years, pressured by rising wages, theft, and soaring logistics costs. Losses from shrink, organized theft, and inventory disappearance alone cost Walmart over $3 billion annually, making some stores completely unprofitable. Layoffs are becoming unavoidable. In 2024, Walmart quietly cut thousands of corporate and warehouse jobs, with another 2,000 positions eliminated at e-commerce fulfillment centers. Each store closure adds dozens more to the unemployment lines, with hundreds of workers per location losing their livelihoods. The company is simultaneously remodeling and opening new stores, but the closures are undeniable evidence that not every Walmart location is sustainable. The cultural impact is seismic. Walmart isn't just a store, it's the backbone of countless American towns. When a Walmart closes, local economies collapse. Studies show that median household spending in towns without Walmart drops by nearly 15%, and small businesses, once reliant on Walmart-driven traffic, face mass bankruptcies. Walmart's stock, while still a juggernaut, has lost nearly 15% of its value in 2025, erasing tens of billions in market cap. The message is terrifying. If even the king of retail can't keep all of its stores alive, what hope is left for smaller chains? Walmart's closures aren't trimming fat. They're an omen that the foundations of American retail are cracking under economic pressure.